Hello, everyone. Welcome to the Friday webinar. We have had a very successful Crystal Gazing Summit 2025, where Vikas was also one of our guests. And that day in that panel discussion where we had Vikas, Mr. Sunil Singhania, and Mr. Ramdev Agarwal, we had a very detailed conversation on way forward in 2025. But because that was a panel discussion, we could not hear Vikas on his detailed views, and that is where we thought of doing this, webinar on this subsequent Friday with you, Vikas, to understand your perspective and your views, way forward. We have seen decent correction that has happened. We were waiting for it, and it's already kind of underway. How do you assess the current, correction, the current consolidation? What is your sentiment at the moment? Let's begin with that.
Hi, Kamal. It's always good to be back with you and chatting with you and all the audience. And thanks, everyone, for joining this afternoon. So, Kamal, I think clearly from September last year to this year, sentiment is very different. It's changed. I think from complete bullish to right now that of greed and from between greed and fear, it's moved towards fear. 6 months ago, it was more towards greed, and that's what the markets are all about. That the market mood keeps swinging, but I think the shift has been very, very quickly. Uh, so I think where we stand today, we have seen a decent correction happening in the markets, almost I think close to 18-90%. In the Nifty levels, and broader markets, I guess far more. I'm sure lots of people are seeing the reds in their portfolio, especially in the mid and small cap portfolio. A lot of dent is there. So every time I think one has to sort of sit back and look back, where is this? What was the reason why the correction has happened, and what's the way forward? So my assessment of I think what has happened last year was that if you see last year, beginning of the last year, calendar year, we had started seeing a lot of tightening in the liquidity in the system. RBI was defending the rupee, and when you defend rupee, you end up sucking out liquidity from the system. You buy rupee and sell dollars. So basically, we were running a very large deficit of 3.5 lakh crores of rupee in the system. Also, because of the election, government spending went down and government release of the payments went down. So as a result, you had twin impact in the liquidity, and liquidity is like a blood supply in body. So that's the reason if you saw corporate earnings somewhat slowing down in Q3 and Q4, so that kind of started playing out, and that resulted into a bit of disappointment and correction, and thereby, right? Now, as fast forward, if you see, two policy pivots have happened. A new RBI governor has come and clearly outlined two things or three things rather, I would say, and he has taken 2-3 measures which are clearly more concentrated and urgent steps. First of all, he has kind of started putting liquidity back into the system. He has announced measure to achieve that, through OMOs and through other things. Secondly, he has also given a comment that instead of 4% target of the inflation, they are comfortable with 4 to 6%, meaning they have kind of pivoted from only inflation targeting towards growth. Thirdly, if you see over the weekend, they reduced the risk weightage of the lending towards NBFC and microfinance. So it basically, essentially, government wants, or the RBI wants the credit growth to come back. So that's a very clear, decisive pivot which has happened. In a normal good market sentiment, such kind of things would have been cheered up and market would have kind of gone up. But the fact that today market sentiment is bad, this entire great news of policy pivot has got ignored. But this kind of policy pivot generally has impact with like it happened other way around in last year with 2 quarters lag. I think this will happen with 2 quarters lag in the economy again this time. So this all infused liquidity will have positive impact, according to me, in with a bit of a lag. Secondly, if you see in the budget, government relaxed tax rates almost up to 12 lakhs, which is a very, very big decisive move. What it does is, it makes post-tax return very solid even in case of fixed deposit. Right, you can make 7.5% post-tax return up to 12 lakhs, which is a very large sum for middle class, for retired people. So the deposit garnering for the banks will go up, Also, I think income levels will go up for people, spending powers will go up, and government, which was kind of holding on payments and kind of slowing down on spending in the last year because of elections, has again stepped up based on our channel checks and all those things. So I do believe that combination of these two things will start having an impact at a margin incrementally by the month, by the quarter, and with a bit of a lag, we'll start seeing good impact on the corporate earnings. So this is the one aspect. Second is, I think there's a little bit of uncertainty around tariffs, what will happen, but that's going to be there. That's not likely to kind of die down anytime in a hurry. My own take on that is there's not going to be any big, game-changing impact on the tariffs. Of course, some adjustments will happen, some sectoral impact might happen, but I don't think there's like wide-scale, derailing of the story happens because of that. Because no matter as much as US wants, they don't have a choice because they don't have manpower to manufacture there. They might move some high-tech sectors there. But again, in my opinion, there are a lot more rhetorics than the realities. Some deals will be worked out both ways. Like I think, US will insist India to import energy from there, but that's not a problem because India anyway is a gas deficient country. So we'll import from there and then we should be fine with that. So I think, there will be some adjustment will happen, but, and that can create some amount of uncertainty. But the fact is that today with this correction, a lot of readjustment in the valuations have happened. Nifty has come in around 18.5, 19 times range of the valuation running 1 year forward. Many large caps companies have corrected. Many mid and small cap companies have corrected 50-60%. So lot of stocks are coming in the range of investable comfort zone at this point in time. So my own take is that maybe we will see large part of the 80-90% of the value damage has been done. Time correction might happen over next 1 or 2 quarters. But again, I would like to take your memory to what happened in 22 around the Ukraine war time. We saw 21 was a great year. 20 was, of course, pandemic year, but late part of 20, market started picking up. But most investors got comfort around only late 21. And so you were sitting on a great market, but 22 war broke out. There were inflationary pressure, geopolitical situation, a lot of concerns were there. And we saw Nifty correcting from 18,500 to 15,500, almost 3,000. So close to 18-20% correction happened. And first there was a value correction, then there was a time correction. It kept on languishing till June or something, if my memory serves right. And then market started going up in July, August onwards. Again, most people were skeptics, that this is not sustainable rally and all those things. And eventually it created 23 was a great year and 24 first half was a great year, right? Before it again peaked out. So point I'm trying to tell you, in a long journey of market, these kind of 15-20% corrections are par for the course. They do happen. They should happen because that makes market also healthy. The froth gets cleared, sanity comes back. All those things are, I think, par for course. So I would say it is very much kind of Ukraine 22 kind of time. Maybe first half of this year would be painful. I mean, large part of the pain is already done, but from time point of view, it might be still taking a little bit more time. And second half of this year, I think that some of the lag effect will start playing out. Most of the uncertainty around US policy should be behind us. Also, probably one big trigger in the market could be, if the Fed starts cutting rate, that could be very meaningful. I mean, one trigger, one catalyst which could meaningfully trigger the market, decisively in the bull mode would be Fed rate cut, because that will also bring liquidity back from FIs to India. That will also pivot the growth-oriented policy for US, and also that will pave the way for Indian economy's revaluation story. So I would say this is where I think the overall landscape is, and I think we have a reasonably good, so this is how broadly, at least, I am currently assessing, Kamal. I have given you a long answer to a short question.
Sure.
I have summarized.
Sure. So, valuations were a concern and a lot of fund managers were taking cash calls, in last part of 2024. Right now, valuations have corrected, but what is your deployment strategy at the moment in terms of, deploying money for a new client or a new top up that comes to you? How are you kind of taking it? Are you waiting or deploying the same?
No, we are, again, it's very stock specific. So I think wherever we have got comfort, we are deploying the capital because a lot of stocks have come in a very, very comfortable zone. See, markets can always fall, stock can always correct, but we are seeing in a wherever stocks we are seeing in a comfort zone, we are just buying. Where we think still some correction can happen, we are kind of waiting. So that point of view, I think it's fine. In fact, around Ukraine war time, we had launched a new strategy that time, contra portfolio strategy. And I remember that time the reason we did it is because most people were like not willing to bite, and we said, in this environment we can reasonably sure tell you it will deliver 15% return. That strategy delivered 38% return and large cap strategy, right? So in fact, we had stopped taking money in that strategy in 23. We have just reopened that strategy from flows perspective. That tells you how we are thinking about market right now.
So the contrarian, perspective on market is like interesting to understand, because every time when market kind of, kind of goes down and then comes up, and that new cycle starts, there are new leaders that come up. So which are those new areas, which you are seeing today are beaten down, or like contrarian lens are visible to you?
I think, in my opinion, banking has been one sector which was doing badly throughout last year and this year as well. I think that could take the lead in the rally this year, is my sense, because and that has also the highest impact of the policy pivot, as I was talking about. So that sector, I think, in my opinion, can meaningfully lead the market.
Sure. The older, long-term structural stories, that you have been running, like manufacturing being one, which obviously, I understand you have mentioned that in the Crystal Gazing Summit also, that, it's a long-term story, but at the same time, there are a lot of investors who are invested in your shift PMS. Should they be doing top-ups in that, or, it's like still manufacturing side of market seems to be expensive?
So again, there you have to see the company specific and all. I mean, some pockets are still expensive, some pockets are within a very good valuation range. So and that strategy might still kind of consolidate for some more time. It might take a little bit longer. But like I said, a lot of froth has got cleared. Some ideas have become in a very, very investable and good range. So from long term perspective, I don't have a doubt. But short term, like the froth gave extra return has been taken away. But I'm reasonably sure that CAGR of 18-20% is not going away. So some part of the correction, I would say that last part of the correction, has already happened. Some part can happen in next course of 2-3 months.
Sure, sure. As part of your, I would say internal assessment and research on the expected earnings for Q4, like 2 months are already done. Are there any indicative signs that you and your team are seeing, which could be hinting on any kind of uptake or downtake, on the Q4 earnings? Q1, Q2, and Q3 earnings were like below expectations, and there is a hope that Q4 earnings will be, showing the upward trend. But is this hope turning into some numbers?
We will only know when it happens, right, Kamal? Because I think expectation is that Q4 should be less disappointing, but we will look for that uptick. And partly, like I said, given the fact that RBI has taken early action, you still have 1.5 months to see that. But it's a very short time, so one can't really say for sure. But I would say that some uptick should be visible. But we will. I think if any uptick is there, that will give cheer up market. If there is not, then probably it will get further delayed. So, but honestly speaking, I don't have an answer whether it will be good or not.
Sure. What are the cues, that you look at beyond normal, valuations to assess the sentiment of the market? Like, are you also sensing out of some kind of money coming to you, or money has stopped coming to you, or redemptions are coming to you, or any other similar cues? If you could kind of,
I think, see, one of the clear thing, Kamal, is that the greed fear is on the high. Fear indicator is on the high side right now. It has swung on the other side, and I know there are a couple of websites which kind of using various parameters. We track the greed and fear indicator, and we see that the fear is right now almost on a high side, and based on our investors interaction also, of course, flows have slowed down. People are inquiring more about how long, how much. That conversation tells you that right now fear is kind of high. But also we know from the experience, like I was telling you, in Ukraine 22 times, that that time fear was high and returns outcomes are different. So it is the time of fear. When you invest, you have a better outcome. Unfortunately, most people end up getting more scared during the time of fear, and not able to take that contra call. So I would say that these are the times which this vintage will drive good returns, will make good portfolio. Not the one, in the best of the time, but unfortunately, most of the time, in general, I'm talking about, not for everyone. Investor psyche is more, seeing the historical return and then give the money or then invest the money, rather than, when everybody's bleeding. So I would say that right now fear indicator is high, and that's what also gives me the comfort that there may not be too much downside. It could be a little bit here and there, and then it should stabilize.
So every time that correction happens, since you would have seen, multiple corrections, it is always happening in stages, and ultimate stage is like a panic stage. At the moment, I don't see we are still in that stage where panic, has kicked in. Though I agree that fear sentiment is much high and greed sentiment has settled. How do you sense this particular aspect?
So I think, again, now I don't know. See, panic typically happens, Kamal, when there is a lot of leverage position in the system. Fortunately, there is not leverage in the system, right? Right now, only loss of value in the portfolio has happened. So I think currently, because of a lot of measures taken by SEBI to limit the F&O exposure, to limit the margin funding situation, that has not happened. Historically, whenever markets have fallen steeply, it has been led by the margin funding selling, right? That unfortunately is not the case. Right now, whatever is happening out of the fear, as I think that probably some of a bit of outflows might, go up in next couple of months if markets don't do well. Like today, I had an investor who came and met me and say, I think markets are going further down, and I want to see, should I, and a large investor, quite decent investor. He said, I think, should I go down? I said, how much downside you are expecting? He said, 5 to 10%. I said, you already taken 20% downside, but for 5 to 10%, you want to, exit and enter as if you will know the bottom. But the point is that tells you the psychology of the investor. And last year, when markets were going up, he was consistently topping the money, right? So the investor who was in the good times topping money now wants to, withdraw. That tells you how the mood swing and fear versus greed has happened. So I would say that, stay put. India's story is intact. There's no threat to India's story. India's structural strength is there. We don't have any current. See, there are 5 major things. Current account deficit is sorted. Fiscal deficit is in good space. Banking system is in good space. Inflation is well managed. Our sort of debt to GDP or corporate debt to GDP is in a very, very comfortable situation. So we don't have any major structural weakness. Slowdown in the earning could happen, but slowdown in the earning cannot create a deep cut. It can create only, and we already seen 20% cut, and India growth story is not over. So I think, in my opinion, somewhere around these levels, market should find levels.
Sure, Vikas. Talking optimistically, if we further try to deep dive the contra perspective, apart from banking, in that diversified portfolio, what are the other themes that are looking attractive to you?
So again, I think, in my opinion, right now, some pocket like cement looks pretty good. Last 4 or 5 years, nothing much has happened in that sector. Consolidation has happened. That can't be imported as a commodity. Investments in the industry will continue, and the infrastructure investment continues. Real estate continues. So all those things, I think, in my opinion, will impact positively in times to come. So cement is the one sector. Pharma will continue to remain still positive. I don't think the major scale damage. If, let's say, there are tariffs in US, it will be passed on because India supplies 45% of the medicine to the US market. So it's not that, that's a fraction of the cost. If there's a tariff, I think they will pass on. So we are still kind of quite optimistic on that segment. We are seeing, IT, there are pockets of interesting ideas and valuations, not in the large cap, but mid cap space. We are quite optimistic about them. So again, some of these themes within consumer, I would say not large cap companies, but some small interesting companies are very, very reasonable and looking within the attractive zone. So I would say that growth stories, some of these sectors I talked about will do well.
Talking about large cap versus small caps, like small and mid caps, we have kind of always been worried over last, say, 6 months that small caps have rallied a lot, and the valuations of small caps and mid caps have become very expensive. But at the same time, large cap valuations were not high, but we are seeing large caps are also correcting equally. It's not that this time large caps have corrected less. You yourselves, started by saying that large caps have corrected by 15 to 18%. And I think, mid and small cap indices have also corrected by similar numbers. Maybe small cap would have corrected more than 20%. But the difference this time is not that much. Why is this, Nifty, despite being already at an attractive valuation, is still seeing a steep fall?
See, whenever if you see correction happens, it is generally liquid things get sold first. So let's say if you want to sell and create cash, it is mid and small cap you will find hard to sell, but mid and large cap can be sold, right? Because there's liquidity. So whenever markets fall, people exit what they can exit. So we've seen bit of a FI flow happening. We've seen bit of redemptions happening in the mutual, in many spaces. So that can obviously create an impact because mid and small cap you can't sell in these kind of times because of the liquidity situation. So that sometimes explains the reason for even why large cap can fall. Then again, things like Reliance has been falling for quite some time, which is a large heavyweight because there's a large institutional investor called Capital selling, exiting from that stock. So some of those are stock specific call in some of the large weights, but I don't see. I think somewhere in my opinion, that's the reason which gives me comfort that market should stabilize somewhere here. I don't see major downside. Banking, like I was saying, looking good. Most of the large caps, whether it is HDFC Bank, Kotak Bank, have not fallen much. So there's not limited scope for falling. IT has already corrected, pharma has corrected, automobiles have corrected. So I think somewhere it's coming in a good zone.
At your respective portfolio levels, what kind of adjustments would you have done? Because many things that you would have liked and they were expensive earlier, you would have picked those, and maybe some of the things you would have exited. So if you could just spend some time to give some indication on what kind of structural changes in the portfolio you have done.
No, I think we've not done any major structural change. We are just, suppose some stock we had and we've come down, some crazy valuation, and we are moving from one stock to another stock. Some stocks we've been wanting to buy is come into corrected, good interesting price. We are enabling them, we are buying them. So again, depends on portfolio to portfolio, but we have made certain changes. It's not like we made a lot of changes, but we made certain changes where either top up on the existing stock or buy new stocks where we think there's some value.
So how are you trying to take the advantage of this fall in terms of creating a new portfolio? Because this is definitely an opportunity, and I have seen many fund managers, experienced fund managers, launching new funds, new, I would say, ideas at such levels. I remember Abacus doing that specifically at every time when markets are like down in the mid and small cap space. Are you also thinking in the same direction?
So one thing is we have anyway contra portfolio is we opened up for the subscription, which we think is going to be with a limited downside, good risk reward is there. So if market falls further, I would see limited downside to that portfolio, but at least there's a lot of comfort on the valuation and downside, and upside can come 15 to 16% kind of thinking. We feel that it can generate that way. Amritkal is again Bharat Amritkal fund, which is open-ended fund. That I think is open for subscription. We just started last year. In fact, we are just waiting for SEBI approval. Hopefully next 1 week 10 days it come. We're opening the lower ticket size Bharat Amritkal fund, which will be with 1 crore minimum. Our current fund is a 5 crore minimum that we will be opening soon. I think hopefully in next week itself. Once we're just waiting the final approval, it should come anytime. So that I think will be open for a very large base of investor where the minimum is only 1 crore instead of 5 crores, which we can kind of then replicate and do it.
So you mentioned about expected big positive event or I would say possibility whereby Fed could cut rates. Now, given the I would say deglobalization oriented thought process that US is currently following or is expected to follow, in fact, inflation could again become a concern in the US. And if inflation again becomes a concern in the US, how are we, kind of expecting Fed to cut rates? What are the drivers of we to expect optimistically on Fed cutting the rates?
No, see, inflation coming back is only a question which nobody knows right now. At least I don't think Trump will be, insensible enough or to let the inflation come. See, when you, as a politician, you talk in election versus reality is very different, right? If you were to go by his election talk, first thing he should have done on when he came to office was announce import tariffs from China. So far, it has not happened after almost 1 month also, right? And still they are talking about it, right? So, now you can go and announce tariffs on anything else, but if you don't have much import on that, it's just a tactic to negotiate and, deal making kind of thing. Fact of the matter is that, even post Biden imposed tariffs on China, despite that China's current account deficit with the US widened, it didn't go down. So it's not that suddenly US can start producing goods overnight. It can't happen. So I'm sure Trump will do some deal, and he will definitely not let inflation happen. He's talking about, in fact, oil prices going further down, which is a very big source of, inflation. So I don't think there's any case for, in my opinion, major inflation. See, people have been talking about inflationary pressure for a very, very long time. I have been hearing because of deglobalization since 2014. But, we have not had, there are patches which comes for different reasons. We saw inflation because of the COVID and shipping price and all those. A brief period we saw when Ukraine war happened and all. But structurally, it's not, remained there. So I don't see there will be major structurally. And keeping US dollar strong is very negative for US economy. So I'm sure Trump will not want strong US dollar. So I guess in my opinion, 3 to 6 months, all those things should start settling down. And only way US pays large part of the interest payment. Large part of the budget goes into interest repayment because they have a large debt. So only way out of that, in some sense, is bringing the interest rates down. Otherwise, you can't reduce the cost. If 5% versus 1%, the cost of debt is very different. So I think, in my opinion, the only way out of that for US is to bring the interest rates down.
Sure. What are the other, I would say, positives which you are seeing at the moment, which are like yet to be unfolded, but based on your learnings of various cycles, obviously, we as investors tend to forget positive things and, tend to be kind of swayed by recency bias, and hence the mood is fearful. But, if we are to remind investors and our clients on what could happen, which is like optimistic and which we are forgetting, do you have any thoughts on those?
I would say that look at again, India is in a very, very big transformative phase. Forget about anything. Only India in this world can think of holding a Mahakumbh with 50, 60 crore people in one place. I don't think anybody can even think of. This is a change in the mindset of India. According to me, India is thinking very, very differently. It is not same India. So, I would say that India's story is for real. We have a lot of innovation happening, a lot of entrepreneurship happening in this country. It is visible to us when we meet companies. Of course, there will always be periods when something gets overvalued, that correction happens and all, but that does not change the underlying India story of young demography, more people wanting to work, consume, innovate. Today, we have startups coming up. Other day I was in, Aero India show in Bangalore. I was like super impressed with how much innovation in this country is happening, how many companies are doing things, in the defense aviation space. You get amazed with to see that they're thinking global scale. So these are the kind of things which India inherently happening in India, and companies are being built from small towns, in B class cities, tier 2, tier 3 cities, which are global in nature. This is a very, very different India. So I feel that though they are not gone away, just because markets have corrected 20% does not mean that those things are not happening. They were happening, they are happening today also. The real crux is in identifying those companies and staying invested into them through thick and thin. I can tell you one thing from experience, having experienced investment for 20, 30 years, every good company is correct 20%, 30%, 40% in their journey. You pick up any company, which has done well, including HDFC Bank to, Asian Paint to Reliance to any company which has scaled up, have corrected, different phases have come. So don't use market price as a judgment on your investment and outcome of your long-term journey. People who stay invested into these kind of tough times, it is very psychological to navigate these kind of difficult times, because suddenly you don't like, you wipe on your portfolio seeing bleeding 20, 30%. It's a very most difficult thing to go through. But these are the times when, going to basics, thinking long term, thinking that are the ones which will help. So I would say only that these are the very, in some sense, sounds very philosophical, but they are the real fact that that's how it works. Markets have its own tendency of going up and down.
So you're not seeing anything which is bothering you this time, which is different. It's like a normal correction of valuations, and which is more or less done. There could be some time correction, and then the optimism will kind of be eventually coming. This is how you are wanting to conclude.
Absolutely. And see, always, no matter what, I can say Six Sigma risk is always, you can never predict them. I mean, unseen, unforeseen, big risk, just like how pandemic happened. Tomorrow, some cyber attack happens somewhere or something happens, you can't predict them. I'm not talking about those kind of situations can happen anytime. Now, later, 6 months ago, it could have happened. So I'm not talking about that. But in generally speaking, I mean, I'm not seeing much kind of challenge. I think somewhere next 3 to 6 months, we have to just hold on to our nerves. And from there, I think markets will do well.
So this is the last question. One key aspect which is like keeping everyone, I would say, inquisitive and at the same time, worried is FIIs have been constantly selling. Like we are aware of India's story. FIIs would also be aware of India's story. The kind of innovation we are seeing in India, the possible.
I mean, may not be true. All FIIs may not be. All FIs may not be still, I can tell you when we meet people, still many people don't understand India's story. Many people sitting in India don't understand India's story. So how FIs will understand it? So I think two things. First of all, some of the sovereign funds, which are very big India bulls, likes of Norges, GIC, ADIA, if you see, they have a highest ever allocation towards India right now. Okay. So they understand India very well. But rest of the money, lot of money comes part of the emerging market allocation, which is linked to the Fed rate cycle. So whenever Fed rate goes up, they pull out money from the emerging market, and India is being part of emerging market also sees the outflows. We in between has seen less outflow because we were also beneficiary of allocation money from China. Now that money is reversed. So now India and China are kind of equal weight and all those things. So whatever little adjustment happened back has happened. Right. So I, frankly speaking, whenever Fed rate starts coming down, we will see a lot of flows coming back to India. Last year, 1 month, we saw positive flows from FIs. That was the month when Fed had cut interest rates. After that, again, US yields went back and, we started seeing outflow. So I think it's very much tied to Fed rate or US interest rates. So I see the moment US dollar starts weakening and, the moment Fed starts sort of cutting rate, you will see a lot of money coming back.
So if you give me 2 more minutes, I'll ask one more question. You mentioned about banking sector, and this was kind of outcome of our Crystal Gazing Summit as well. Banking sector has like PSU banks as well as private banks. We have seen in the last rally, PSU banks did participate, but private banks had not participated. And obviously, this is a broader question that some of these old economy sectors like PSUs, defense, railways were the flavor of last bull run. This time, when these stocks have also equally fallen, when you are kind of wanting to kind of build a portfolio within banking and outside of banking, are you going to go back to the older, theme, or like, this is going to change this time?
The voice is breaking. I couldn't hear.
So I'm saying, in the earlier, rise, the last bull run, we saw it was dominated by PSU banks, infrastructure, and then manufacturing, and then, some of these like railways, defense, but private sector side of, market, which is like private banks, pharma, IT, these were not participating. Hope I'm audible. Am I audible?
I just lost you in the last again. So you were saying defense and railway. So this time which will lead the rally? I think again it will be led by, in my opinion, banking sector, both private and public. Overall liquidity levels will go up. So that will, I think, in my opinion, will be led. Then there will be, I think this time around probably infrastructure stocks could also take a good lead because there's a good order book execution is happening. Their valuations are not very strong, especially the EPC companies. I think could be probably interesting. Some of the pharma companies could do well, in my opinion. So these are the 2-3 sectors can lead, and manufacturing can. I mean, it's not a large sector, but there are lots of pockets of opportunities. Automobiles, especially in the two-wheelers, I think we are seeing good recovery coming, but that sector can do well. I think PV and CV probably might take some time, but at least two-wheeler segment can lead. So some of these 3-4 segments I feel can lead the rally.
Any of the questions that you see in the chat box you want to answer?
I think I'll have to find up Kamal, but let me. I think Fed we have taken. Please explain contra strategy more. Is market cap spread overseeing sectors? So I think contra strategy is mostly large. 60-65% will be large cap, balance mid and small cap, reasonable valuation, lot of margin of safety. Where we will see good ROE, 15% plus ROE. PEG ratio will be 1 or less than 1. Where we either some of the sectors, basically 3-4 segments, where either there are industry which are facing temporary headwinds or they are going through cyclical downturn, but we see a recovery happening in 6 to 12 months, and stock market performance has been bad. So let's say, for example, cement stocks, where we see, I spoke earlier, some of the banking stock is available at 0.5, 0.6 book. Some of the automobile stock which are available, reasonable correction after 30, 35, 40% correction. Some of the special situation stocks where we can see a good unlocking of the value happening over of 30, 40% in next 12 to 18 months. So those are the kind of 3-4 buckets. Good value stock with a good dividend yield, but traction to recover, grow 10 to 12%. So 3-4 buckets we will pick up where the margin of safety is huge, but so downside is limited, but upside at least 15 to 16%. We should be able to do that kind of mindset. We will select the stocks with, of course, what outcome comes we will see, but generally we think the risk reward is in favor. So those are the kind of things we will do. Now, which PMS should you consider? See, if you are a growth-oriented long-term investors, I think Bharat Amrit shift both continues to remain very promising. If you want to take little contra bet with a little bit more safety towards that gives people more comfort, I think you can choose that. So between 3 of them, you can choose any, depending on your sort of outset and all those things.
Sure.
Thank you very much, Kamal. I'll have to rush.
Sure.
Thank you very much for your time.
Thank you very much. For everybody's final understanding, contra strategy is a strategy which plays on possible PE re-rating. There are a lot of stocks and businesses which are like beaten down, and possible uptrend could happen, and hence the PE is down and the re-rating could happen, and hence margin of safety is high. It may take time to recover, but it's like a fund which at this point of time can give higher returns. But at the same time, the shift strategy is more of a secular, which is a long-term growth story where valuations could be higher and there could be some pain in the near future, but it's a long-term growth story, as Vikas was mentioning. Thank you so much for joining for this webinar on this Friday. Thank you once again.